All right, everybody, we're going to go ahead and get started. Thanks so much for being here this morning. I'm Rachel Black, and I co-direct our Family-Centered Social Policy Initiative here at New America. Today, we're going to be talking about how public policy can help bring more Americans into the financial mainstream. And by that, I mean making sure that households have the basic tools that they need to do things like pay their bills or save for an emergency, also have access to the credit markets that they need to cover shortfalls in their income and to make investments that will increase their economic security over time, like paying for college or buying a home. What we're going to hear from our panelists, though, is that access to these tools is incredibly uneven, and it's oftentimes the consequence of biases that are baked in to how institutions and markets and even public policies are structured. So these are really the core themes that we're going to be digging into this morning, and I'm really excited to be joined here today by Mehrsa Baradaran. She is a professor of law at the University of Georgia and the author of How the Other Half Banks. We also have Alita Sprague, who is a fellow in the asset building program here and is the lead author of Inclusion by Design, which is a look at the history of U.S. welfare policy and how stigma has provided a wedge and advanced financial exclusion among really the most vulnerable families in the U.S. And Jillian White, who's a senior business editor at The Atlantic and has done really extensive reporting looking at the disparities in access to quality financial tools. So I think these are all very solid credentials, and I'm really glad that you're here this morning to have this conversation. So Mehrsa, I want to start with you talking about, I think, the thing that we have to start talking about, which is the events of the last couple of weeks with Wells Fargo, right, coming to light that hundreds of thousands of credit card accounts have been opened up without the knowledge of the consumers themselves. Rightly, this has directed a lot of attention and concern. There was a hearing of the Senate Banking Committee earlier this week, and Elizabeth Warren, I think, rightly called out the CEO for wrongdoing. This conversation brought to mind a quote that you have in your book from Louis Brandeis, and I think it's fair to say you're at a New America event if you're starting the conversation with a Louis Brandeis quote. So the power and the growth of power of our financial oligarchs comes from wielding the savings and quick capital of others. The fetters which bind the people are forged from the people's own gold. And I think that goes so directly to the disintegration of the social contract that you document in the book. So I'd really like to get your reaction and putting the events of Wells Fargo kind of in a historical context.
Yeah, so it's interesting because I think we focus on the wrongdoing of individuals, and so you have Senator Warren rightfully calling out this one bad actor, right? But it's obviously much bigger than that, and we allow this system to exist whereby banks are not working in the best interest of not only their customers, but of the public at large. And so this is exactly what Louis Brandeis is saying. We empower banks through our deposits, not just that, right? And it is much more so today than in the days of Brandeis, but through the entire federal government infrastructure, we allow banks to exist, right? Banks do not exist without the state. And it's not a subsidy, right? Calling it a subsidy is a huge understatement, but it's an apparatus that we create by which banks can function, right? FDIC insurance, Federal Reserve liquidity protection, chartering, right? Banks are essentially the hands of the state, right? Not the invisible hand of the market, but very literally the state enacts credit policies through banks. And so insofar as banks are entangled in federal government policy, they should be working for the people. And what I highlight in the last 30 years is we've had this erosion of this understanding. It used to be quite tight. Even as Brandeis is calling out the bad acts of the banks, FDR is saying, you have not worked for the people, we will reform you. We have lost that conversation, I think, over the last 20 to 30 years, as we've started to treat banks like any normal market actor out rightfully for their bottom line, right? So go ahead and make profits, and efficiency is the name of the game, right? Lower regulation, higher profits, you go and do the thing that you do, and the public is over here on this side. And I think that is a breach of the social contract, because if that were actually the scenario, then we wouldn't have bailed out the banking industry in 2008, right? We wouldn't still be providing all of these subsidies and this infrastructure that allows them to exist. And so insofar as we're going to support the banking industry, they need to work for the public. So when you have the CEO of Wells Fargo, by the way, that owns, 70% of the mortgages, something like, 30-something% of the deposits of the country, right? This is an institution that is firmly embedded in the government infrastructure. I mean, it's like the Bank of America CEO, which is similarly situated to Wells Fargo. When they took the bailout, is it Ken? Can't remember his last name now. Anyway, the CEO at the time of the bailout said, we're in this together, right? The government and Bank of America. And he was meaning this in a patriotic sense, right? But the negative there is that, of course, we're in this together. If Bank of America fails, we fail, right? And so we have this system, and when the CEO is caught sort of screwing his customers, the people, we should be rightfully alarmed. And so I think that's the conversation that needs to happen, is who are the banks and the bankers working for? And if it's not the people and it's their bottom line, then we have to reorganize the federal infrastructure to make sure that we're not actually supporting them. Now, I think that is not realistic. I think we have to support the banking industry because of a variety of infrastructure reasons. But I think if we're going to support them, then we have to require something, which is what Brandeis said. Maybe make them public utilities. Not quite go that far, but at least public serving private corporations.
So let's tease that out a little bit more. A contract is an agreement between two parties, right? Mm-hmm. And I think that you gave a great overview of how, in particular, the private sector has defaulted, right, mm-hmm. on their end. Talk a little bit more about really the role of government in this, because I think there's a really popular perception that government involvement in the financial system is meddlesome, rather than really fully appreciating the extent to which the federal government creates the markets.
Absolutely. I mean, look, before we had FDIC insurance, before we had a Federal Reserve, we hardly had a currency. We couldn't bank in a proper way, right? It was pre-industrial revolution, right? We've got every bank handing out their own notes. Some of them would just, in the days of wildcat banking, they would just disappear. So they would give you a note, you'd put in your deposits, and you'd go and the bank would be gone, or they'd relocate, so you'd never find it, right? So the federal government came in here and took control of this banking industry by creating all of these infrastructures by which we now trust our money to the banking system, not just in our deposits, but through credit, right? How is the American middle class created? Well, it's through the FHA loans and the HOLC and all of this Federal Reserve guarantees. Our pre-Federal Reserve was FHA, Fannie Mae, Freddie Mac, right? These government-sponsored institutions that created these mortgage markets and used banks to push them and create this middle class, right? So you've got the thrift industry, the commercial banks, all of this money pumping out through these banks. This was the federal government doing this, right? And the banks were profiting. There was a famous 3-6-3 model, right? 3% pay 3% on deposits, charge 6% on loans beyond the golf course at 3 p.m., right? But that was created by the abundance of credit and the safety by which people could borrow on home mortgages because of these government guarantees. So that is all, and I am not saying that that's a bad thing. I think that's a great thing, right? Great. It would have been. The footnote, and it's a huge footnote, is that also created a racial divide because, of course, that money did not go to the red line districts, which were all black and minority. So putting that aside, which is not an easy thing to do, but for the people that got that bonanza of credit, it was a hugely wealth redistributive thing, and that is how the modern banking industry, that is the legacy of it. And so I think to say now, well, now the government should just leave them alone, we can't. They're part and parcel. We saw that in 2008. If the government had left them alone, we have Tim Geithner saying we would have been in shanty towns. I don't know if that's right, but if but there was such a tie between the banks with each other, with international players, and with the government that if we had let AIG default on their insurance products, or JP Morgan fail after Lehman, it could have been the collapse of the financial sector. And so no rightful government is going to allow that to happen. So I think they're bound whether we like it or not.
So what I hear you saying is the government entered into this contract, right, with the expectation that the financial system would be meeting a public need, right? And what we've seen over time is a constriction, right, of who's benefiting and under what circumstances. Talk to us a little bit about the two-tiered financial system, who's on top, who's on bottom, and really what the impact of that is.
Yeah, so when we rewrote this social contract somewhere in the 80s, we deregulated and said banks can go out and make a profit. And what happened, of course, is that they merged and they went toward higher profit areas. And that was expected, right? This is the thing that the banking regulatory regime was trying to fight for 200 years since Thomas Jefferson's era, right? So Alexander Hamilton says we need a strong banking sector. Thomas Jefferson said, if we have strong banks, the agrarians will be left out. I mean, he was right and also very wrong, right? But, because we didn't end up becoming an agrarian country. But the point was that the way banks are structured has huge implications for equality and access to credit. Okay, so what happens is we deregulate. We say, yes, banks go wherever you want and do basically whatever you want. Now, with a big caveat that not anything. But so what happens, which is natural, is that money goes to where there's more money, right? So banks conglomerate, they become big, and then they leave areas that are no longer profitable. What are the first areas that are left? Of course, low-income areas. They lose their thrifts, they lose their credit unions, they lose their commercial community banks. Now you've got 5 or 6 banks that control the majority of these assets. So there's this bifurcation that happens in the banking industry where we've got the middle class and the wealthy who can still afford those that bank credit and those bank services, and then we've got this whole sector of the low income or low to moderate income who cannot even afford a bank account anymore. And so what happens there, as soon as those community banks leave, is those fringe payday lenders come in and fill the void. And by the way, there's a direct correlation. There was no payday lending, no check cashing before this happened, right? You used to be able to do that at a community bank. And once the community bank deemed those products unprofitable, they left, and the fringe bankers figured out how to make huge profits from those loans, right? By huge profits, we're talking 300% APR, et cetera. And so we've got this system, one, these credit subsidies coming to the wealthy and middle class, and then the poor are left to the market. And not only just the market, but it's the loan sharks of the market. So that is who serves that industry. And so the less money you have, the higher you pay for credit, the higher you pay for financial services. And so I see this not just as an economic market failure problem. This is a problem of democracy, right? Because we are still supporting those banks and we're leaving those others out to the sharks.
You have a really great quote in the book that creates a metaphor for the kind of financial tools that middle-class families have access to, suggesting it's like juggling hacky sacks, or you don't say hacky sacks.
Yeah, so the middle class, right? So the middle class essentially, we juggle, we have our issues, right? So we, maybe we aren't smart with money, and we've got student loans here, and mortgages, and so there is this juggle, and so people say, yes, I've got this, shortage of money here that I've got to pay here, but the poor, they end up juggling with knives dipped in fire or something like that, right? Any misstep here is hugely catastrophic because you're borrowing from one lender, you're paying off another, you're running on a very short buffer, and this is not created by your bad mistakes, or any mistakes by the poor. Now, I'm not saying that it's smart to take out a payday loan, but it is a fundamental misconception of poverty to blame the poor for taking out these loans when this is the only option available to them. So yes, I think the abyss is a hard one for people to fall into when anything happens. I mean, you talk about evictions, hunger, loss of job. I mean, people are struggling just to even have regular hours. We're not just talking about minimum wage here. We're talking about someone being able to keep a job that has regular hours, 1 month to the next. And that is a situation that you end up needing credit sometimes to bridge that shortfall. And when they do need credit, what we offer as a society to them is, here's an anchor. You're going to sink quickly with that.
Yeah, I think that's a really important point, the way that exclusion in this space replicates in other ways. And just going back to the point you made about redlining, there was recent research that came out showing that the geographic areas that have access to Amazon one-day delivery are the ones that are outside of the redlining districts, right? And if you were in a redlined area, chances are you do not have Amazon one-day delivery. But there are actually implications of financial inclusion that are a little bit more consequential than that. And Jillian, you spent a lot of time in your work talking about that, about how financial exclusion replicates in other ways, like a lack of access to credit, being a barrier to having a good match, right, when you're out of work and needing to take something that's right in front of you because you can't bridge sort of those gaps in income, or how it gets passed down intergenerationally. Could you weigh in on that?
I mean, when we look at cycles of poverty, talking about the financial system is a great place to start because it is the thing that breeds it. It is the thing that keeps it going. And I think the FDIC just came out with numbers recently. The full report isn't out yet, but they said something like 7% of Americans are unbanked. They don't have any accounts whatsoever with a financial institution. And that is actually a decrease. But for the number of Americans that are underbanked, who do not have adequate access, who don't have access to credit products, who don't have enough, or who are using these fringe products that are very expensive, that number is around 20%, which some would say is a conservative estimate. And that number has not moved at all. And the thing is, we end up in this place, as Mehrsa was saying, where one, what we do is we blame people who are low income or who are poor or who are using these products for not being smarter, not being savvier, not having better jobs, not having better education, not getting out there, being lazy, having drug problems, et cetera, et cetera, et cetera. And then what we say to them is, here, use this other thing that is wildly unregulated and that is possibly predatory, and use that to get back on your feet. And then when you're unable to repay it and you end up in a bigger hole, by all means, go to your minimum wage job and try to use that money to pay your rent, to pay for gas, to pay for your car, to pay for all of these things. And there is no room for error at all. There's no room to get a parking ticket when you are at the job that you were already late for because you don't have childcare. There's no room for error there. So when we blame people, it funnels into this cycle of guilt and shame about their monetary situation, and that breeds into all of these other things that they're unable to do. So it's this vast financial spiral that we put people in and then say, good luck getting out of. And I think one of the awesome things that Mehrsa was talking about is this bifurcation that we have of the way the federal government deals with the banking industry, right? So we know what animal we have created, which is a profit-seeking animal. That's what it is. We allowed that to happen. We deregulated. We did these things. But on the top, when the banks seek so many profits and get so crazy that they get themselves in trouble, and then everyone, it's a problem. And the government steps in and says, no, 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 that can't happen. But what happens at the bottom of the scale when we say there are all these predatory products that are unregulated, people can't get bank accounts, they can't get access to credit cards, they don't have a good credit score, which disallows them from getting everything from basic utilities to a home. What they say is, well, the banks don't want to lend to those people because it's risky and there's nothing we can do about it. And it's like, but we know that isn't true because there's this very strong tie between these links, right? So it all plays into each other, and when we talk about cycles of poverty, you know, this is a good place to start.
So blaming individuals for systemic problems seems like it creates a natural segue into elitist work on the welfare system. I think something that's deeply concerning but not really recognized when we talk about issues of financial access are the ways that this bifurcation is actually replicated within the social policies that are explicitly intended to increase financial security among vulnerable households. Can you talk about how those dynamics work?
Sure. So I think the history of our broader welfare system being sort of bifurcated, goes back many decades. I would trace it probably to the Social Security Act of 1935, which sort of created these two different tiers with, social insurance programs, which are universal, like Social Security, which are much easier to access, much fewer hoops to jump through to access them. Benefits are greater, the funding is more secure. And then you have means-tested programs that are much more stigmatizing, lower benefit levels, harder to access, and relegated to the states. So states have a lot of discretion in determining both the level of benefits they're actually going to provide, their own eligibility rules, and that has real implications both for access and for political support of these programs. But I think in terms of the issue of blaming people in poverty for their poverty, that is very much reflected both in prior policies within welfare and in modern day policies. And I think our welfare programs in general are designed around the theme of distrust, which I think is sort of an interesting contrast to what Mehrsa writes about in the book about the government kind of being responsible for maintaining our trust in banks, and meanwhile, when it comes to financial inclusion and providing basic cash assistance to low-income people, distrust is really the prevailing norm. So I think you see that both in the form in which benefits are delivered compared to other countries around the world. In the US, there's a really high preference for in-kind benefits versus cash. We don't give people cash. We don't trust people to know how to manage their own money and spend it to meet their own needs. And more explicitly, recently, there have been these restrictions on where and how people can access their basic cash assistance, which is very minimal. I mean, it's really only a few dollars a day in most states, and those levels have stayed where they are for about the past 20 years, so they're declining in value constantly. But there was a federal law in 2012 that prohibits families from using their EBT cards at casinos, strip clubs, and liquor stores. Like, this is a purely stereotype-driven policy at the federal level, and states have really run with it. Some of them have added additional institutions that are prohibited. It includes things like tattoo parlors, like lingerie shops, all manner of things that perpetuate a certain ideal about waste and fraud. And what this means practically is, like, there have been many ATMs disabled for people using EBT cards. In California, it was 6,500 ATMs that are actually disabled as a result of this law. There have been proposals in other states to eliminate cash assistance more generally. You just can't even access any cash with your EBT card, or it's only reserved for certain uses. So I think this is sort of a vicious cycle as these policies sort of reinforce the stereotypes that they're based on. And at a broader level, I think it reinforces the idea that mainstream financial products are not for low-income people. People are defaulted into these EBT cards with limited functionality. You can't make online purchases. You don't have the same consumer protections as a bank account. But you're defaulted into this system. And I think, so what banks have sort of communicated to low-income communities through imposing these fees on accounts, saying, these accounts are not for you. The government is kind of doing a similar thing by saying, even if you have a bank account, you might not be able to get your benefits directly deposited there, and you also aren't allowed to save any money. So I think these, all of these things together really perpetuate a system that is very unequal and builds off of a long history of doing the same.
Yeah, so I think a thing that's cutting across what all of you are saying is that there's really nothing inevitable about this, right? I mean, this bifurcation is a result of choices that are made based on expectations for who these products and services and policies are serving, right? And Mehrsa?
Yeah, so I think one of the things that we can't ignore here, I mean, there is this poverty issue, which I talk about in this book, but there's, I think if you're not putting race on the table, it's an incomplete conversation, as you both do very well in your writings. But I mean, just to contextualize it, you've got federal government policies that not only segregate it, I mean, this is so pre-Great Depression, we're talking about segregation through violence and racial covenants. And then you have post-New Deal era redlining, which is essentially white affirmative action. I mean, literally just, social welfare policies and credit just for white people that not only, creates this self-reinforcing positive loop for the whites, but also a negative one for the blacks, because as soon as a black person owns a home in a community, that home devalues, and so they can't build wealth. So you've got these systems that are created through social policy, and when the end result is you've got a community that's poor because they have not been able to accumulate wealth, and then we blame them for their own poverty and say it's because you're spending it at strip clubs or liquor stores, and therefore we're going to limit the policy that you get. So as soon as the state starts to benefit or think about benefiting people of color, that's when we start saying, well, you don't deserve it and you're taking advantage. And nobody ever said that when the affirmative action was for the majority white culture. And so I think that is the hypocrisy at the heart of it. And I think there has to be a recognition and a real sort of, I don't know, like a truth and reconciliation, which we never have had about this, right? This wealth gap was created by the state, and now our welfare policies, as they are not sufficient to undo that wealth gap.
Yeah, and I think this is something that comes up so powerfully in Ta-Nehisi Coates' case for reparations, just documenting the extensive history and how these choices compound over time, right, and create this narrative of choice and action when it's really a case of dominance and subordination, right? And I think part of that reconciliation is recognizing how that's still perpetuated, right? How that's continued to, how current policies are shaped really around that narrative. And Alita, this is something that really comes out of your work. You know, when we think about who policies are designed for, I think an incredibly prominent figure within welfare policy is the welfare queen, right? I mean, how much of our current policies are based on the expectation that people who are in poverty are prone to criminality, right? Are lazy and shiftless and won't work unless coerced. And these are, we think of states as being a laboratory of democracy. I mean, there's really a case in TANF in particular where they're innovating in the most pernicious way possible, right? Can you talk a little bit about that?
Sure. So I think that is very much a defining feature of the current welfare system we have. I mean, there are so many examples of policies that are based on stereotypes and just further stigma within the system. There are 15 states that require people to take drug tests to qualify for a TANF. There are 15 states that prohibit families from receiving additional benefits if another baby is born while they are receiving assistance. This is the so-called family cap policy, and it's based on that. It's based precisely on that stereotype of the welfare queen. It's presuming sort of the ridiculous notion that a woman would have another baby just to receive at most another couple dollars a day in benefits. California just eliminated its policy after a long-standing advocacy campaign, which is great news, but there's still 15 states that are doing this. There's drug crime eligibility, which was part of welfare reform. It's another way that I think we conflate criminality and poverty. And drug crimes are the only crime that get you, that make you ineligible for certain types of benefits. The list really just goes on, and I think the newest examples are these restrictions on how and where you can access your benefits, which are really just rooted in this perception of fraud and which is not supported by evidence. And I think the welfare queen comment that Reagan made was a turning point in this, and we've seen modern iterations of it too. I think we've talked about this before, but the Newt Gingrich example of a woman allegedly using her food stamp benefits to fly to Hawaii. If anyone who knows anything about the program or has accessed it before knows that's completely impossible. SNAP benefits are limited to food and can't even be used for basic necessities like diapers, much less a plane ticket. So these narratives just get rehearsed and reinforced, and I think that they started far before the welfare queen comment was made, but now they've just become so deeply entrenched that they become a guiding principle for how we structure policy, and it's destructive both in terms of giving people access to benefits and ensuring these programs remain viable and get the funding that they need. And it's really just a sharp contrast when you look at the restrictions that are placed on benefits given to people who are in poverty compared to those that are more universal. And it's reflected directly in the financial products that are used to distribute these benefits. Just as one example, in, I guess it was April, was Financial Capability Month, National Financial Capability Month. And one thing that Treasury did for that was they unveiled this new app for the Direct Express card, which is the card that unbanked people who are receiving Social Security can use to access their benefits. And with this new app, they could find free ATMs, they could check their balances and their transaction history. There was even a little rewards program for doing certain like financial capability activities. And this is just such a sharp contrast to what we're saying to lower income people receiving benefits. Instead of giving them tools to find surcharge-free ATMs, we're saying, actually, we're going to limit the number of ATMs you can even access. And in most states, even to use an EBT card, a government-issued financial product designed to help people in poverty, there are fees attached to many of your transactions. Even checking your balance in some states comes with a fee. So I think the issue isn't that we don't know how to design these products that are more consumer-friendly, that are more flexible, that do actually respond to people's needs in the world, is that we're making a choice not to do it. And I think the narrative of the welfare queen and all these other stereotypes that become embedded in policy directly feeds into those choices.
So let's pivot then to solutions, right? Because I think, as each of you have identified, we know how to do this because we do it for the people who are on the top tier and basically withhold from people on the bottom tier, right? So when we're thinking about solutions, Mehrsa, I think we really need to call you out on the axe you have to grind with George Bailey, right?
No,
and he's a recurring character in your book, really showing that there are a lot of false solutions out there, right? That if what we're identifying as the problem is a systemic failure, then these kind of localized or one-off ideas, like having an app for financial inclusion, are leading us in the wrong direction, right? They're just efforts at remediating and will never be successful without the systemic reform. So talk a little bit about what you see as being false solutions and contrast that with being features of the systemic change you think is necessary.
Yeah, okay, so there's a couple myths out there in banking that I think I'm trying to grapple with, right? So one is this George Bailey myth that actually starts with Thomas Jefferson, right? So this is this idea that the community, through pooling its resources, is somehow going to overcome systemic poverty, right? And so George Bailey, through Bailey's Town and whatnot, right, is a thrift. Now this is based on the thrift industry and the credit unions, these populist, progressive ideas of cooperative action. And I don't want to be an anti-cooperative action because I think this is sort of one of the, pillars of left progressive reform. And I think it's great, but it has its place. And the reason why these cooperatives were so successful, namely the thrift and the credit union, George Bailey's bank, were that they were heavily subsidized by the federal government, okay? When FDR pumped mortgage loans, it's through these thrifts. He creates an agency that insures them. Same with the credit unions, right? He legitimized them. Pre-1910, during the progressive and populist era, these thrifts were scrappy. We're going to pool, they were like microfinance, right? We're going to pool our resources and we're going to do this thing. But they weren't at all engaged in sort of systemic poverty alleviation. And so every time we talk about these problems, the solution, one solution that people come up with, and I'll talk about some of the other myths, I think, one is community control, grassroots, cooperatives, right? And I think, again, I don't want to knock these, but we've got a systemic problem here, okay? We've got government subsidized credit that's not reaching down. And so this idea that you're going to have a poor community overcome macro forces through microfinance, I think is a myth. And George Bailey, great bankers, we need more of them, but it's not enough. The other myth is financial education, as you pointed out very well, this idea that poor people just don't quite understand how to manage money, right? And if you think about this for a second, or if you try to imagine at all, if you haven't experienced poverty, But if you try to imagine it, it just cannot be further from the truth. When you are skating on thin ice, you know that ice very well, much more so than the middle class who operate with a buffer. In fact, there is great research on this, namely the psychology research, sort of the scarcity mindset idea, right? So poverty and scarcity do create this tunneling where you ask people coming out of a grocery store, middle class and poor people, how much did you spend on toothpaste? The middle class person has no idea. They ask them what their final bill was, no idea. Whereas you ask someone who's poor, they know exactly what they spent on each item in their cart and how much the total bill came out to be. They have to know, right? And so this idea that they don't know where their money goes and they're just frivolously spending, we just need to dispel that right away. So if we're talking about financial education, it's got to be to the policymakers. The other myth, I think, is fintech. This is this fintech as in financial technology. So like Bitcoin, blockchain, mobile banking, all of this stuff is going to fix it. And I think, again, I don't want to be anti-tech because I think that will be the place where blockchain has amazing potential for equality, right? Blockchain means you take out the middleman. We're transacting person to person. I think this is a really great technology that Bitcoin is built on. But we have still 40, 50% of the population that operates in cash, right? So there's a missing link there, okay? Before we can get to digital solutions, which I think is the future, we've got to equalize the market at this point. And the other, I think, myth is that we'll just regulate away these bad loans and they'll go away, which is the payday lending will just knock out payday lending. And this, again, when there's a demand, there's going to be a supply. So if you regulate away one product, it pops up in another form, goes into the black market. So I think we really have to be thinking about systemic solutions. And so that's the myth busting. I have some ideas for solutions ranging from small to large. The one I propose in this book is, when we're talking about the lower income, we think about starting to offer services through the post office. The postal banking is the idea that I've had in this book that I've been talking about all over the place. And it seems at first like, oh, that's such a dinosaur of an institution. Well, I say, yes, it's a dinosaur, but it's not a shark, right? So I think you've got this post office that exists in all of these areas that are low income. And it used to give bonds in the U.S. from 1910 until 1966. The post was where you went to save your money, to save, purely savings, not these financial products, right? We stopped doing that. Now we don't have people saving, right? I think there's a direct correlation. You've got Japan and Germany that continued their postal savings bonds, and they do have people that save. So I think letting the post office sell savings bonds through Treasury, cheap bonds you can invest in, right? Provide one buffer, remove some of that scarcity. The other is financial transactions, check cashing, remittance. This is stuff that people pay too much money for, that is virtually risk-free, that the post office is primarily uniquely positioned to do. Lending, possibly, right? One thing I think is easy savings can diminish the demand for loans, but insofar as you do need credit, why not get a installment loan from the post office, 10% interest, something safe, right? Tide you over, we come up with a plan to pay it back. Post office, at least the unions are willing and able to do this. We just need some will. Now this looks to a lot of people like a subsidy. I think if we're talking about subsidies, again, let's focus back on Wells Fargo and Bank of America. I think this is just an equal playing field.
And I think, some of that shock may also be because of a lack of absence of context and recognition how extensively the government is in the business of directly offering products and services, credit for home ownership, for college loans. MyRA is a retirement product that Treasury rolled out just last year. So there certainly is a case to be made for a larger role of the public sector in shaping this outside of its role as a regulator, right? As shaping, sort of exercising regulatory authority. Jillian, I'd really like to bring you into this because as we're talking about solutions, something that you've recently written about is sort of the black bank, right? The effort to move money from mainstream financial institutions into black-owned banked. And I think Mehrsa gave us some of the historical context that I think could call into question maybe the durability of that movement, but certainly there is an earned mistrust, right, of participating in the formal banking sector. So sort of from that vantage point, I mean, what are you seeing as good alternatives?
Yeah, absolutely. I mean, so the movement, the Bank Black movement makes a ton of sense. I think everyone can understand where that sentiment comes from, why people would say mainstream white banking services are not serving our community and are part of a larger apparatus that continually oppresses Black and brown people in just about every facet of their life. Why don't we instead take our money and siphon it into these smaller community institutions that have historically had our best interest at heart? And Black banks, you know, before the civil rights era and before major banks were forced to come into the community and do work and supposedly give loans and treat people equally, they were responsible for everything, for giving home loans, for getting churches started up, for small businesses, for all of these things. So I think the desire to harken back to that time where the community can support itself, I understand where it comes from. The problem is the banking apparatus has changed dramatically. So all of the Black people in the community siphoning their funds into their local community bank is not going to shore that bank up enough because we have a different regulatory apparatus, we have different requirements, we have all of these issues that need to be changed systemically in order for a bank like that to thrive. And that's not to say that effort should not be made to help these banks thrive. It just means that simply starting an account isn't going to do it in the long term. It doesn't mean that 25, 30 years from now, when these people's children go to get a loan from that bank or want to start a business in that community, that that bank will be there because 20 years ago they put, you know, their $100 and their paycheck into that bank. The system needs to change. Community banks are having a hard time in general, and that is what most minority banks are. Some real change would look like federal carve-outs for those banks, a change to the regulatory structure of those banks. And those are things that, if this is a real effort that goes forward, need to be agitated for. It can't just be a movement of capital. A carve-out would be, so after the crisis, when in Dodd-Frank, for instance, they said, okay, these are going to be the capital requirements for the major banks, so we know that they are safe and sound and they aren't going to throw the entire economy into the toilet. A lot of smaller banks said, we can't have that percentage of capital on hand. That is so onerous to us. Or they said, you know, this is how many times you will have to report this particular facet of your structure. And smaller banks said, the sheer cost of hiring people to monitor that or to report that or to get that data will hinder us in a way that it won't hinder a Wells Fargo, who they can have an entire compliance department. They can hire thousands of people to do this and run these numbers all day long. A mom and pop shop, or, you know, in banking terms, a mom and pop shop in a community cannot do that. So there are already some carve-outs for these smaller banks. If what we really want to do is help these smaller banks and help minority banks in particular serve communities that feel like they are still not being served by the mainstream, then that is something that would need to be looked into probably.
Okay, I have one more question for the panel, and then I'm turning it over to you guys, so be thinking about your questions. Alita, this is for you. To quote Reed Kramer, inertia is powerful, right? And this is definitely true in policymaking. TANF has an extensive history of structuring policy around racialized bias, right? And this is something that you demonstrate in the paper. And this is constricting the financial capability of the people within the system. You know, we've talked about options that would make improvements around the margins, but I feel like what you do through the paper is really indict the entire program, right? That as long as the people who are in the position to dictate what the program looks like look the way that they do and come with the biases that they have, like believing that the program serves as a hammock, right? That just supports idleness. That there isn't a lot of potential for meaningful reform, but you do identify a few things in the paper, including structural changes to the program, as well as changes to the policy-making structure itself that would acknowledge people in poverty as as stakeholders in that decision-making process. Can you talk through a little bit of what you feel like is, on the frontier?
Sure. So just to start with your last point, I do think that something that's long been missing from our anti-poverty policy in this country is actively consulting people with lived experience of poverty to learn more about what their experiences are and how those experiences can be best accommodated through the policies we're creating. I think that can both make programs be more effective. It can disrupt stereotypes that are currently driving policy design, and also identify unintended consequences of policy choices. There are just a couple examples of this that I mentioned in the paper. One policy that we've thought a lot about in the asset building program are asset limits, and there's been research now showing just the existence of an asset limit, deters bank ownership. Regardless of where it's set, it creates this perception among people receiving assistance that their financial transactions are being monitored, their accounts are being monitored. So I think even if we sort of fix the supply side of the equation and establish accounts that are sort of safe and affordable, as long as people feel like constantly under surveillance if they're participating in these institutions, I don't think we're going to get as many more people integrated into a mainstream financial institution as would be ideal. Another example I think comes from, there's a program that I talk about briefly in the paper, which was actually a conditional cash transfer program in the US. Conditional cash transfers are most common in more developing countries, but there was one in New York City. And one positive benefit of it was that it did increase the financial inclusion of recipients. Their bank account ownership went up, their savings went up, but it didn't have the same it didn't have as positive impacts on human capital development as was expected. And that's part because some of the incentives within the program were based on presumptions rather than reality. So one of them was, to increase take up of preventative health care and access to health services. And it turns out most people participating in the program were already doing that before the program was initiated. And if there'd been more of a dialogue there, I think that could have been understood earlier on in the process. And this isn't a new idea to involve people who have experienced poverty in the design and of policies and programs. This is something that was actually a big theme during the War on Poverty, this idea of maximum feasible participation. It's also an approach that's gained a lot of traction in international development through things like participatory poverty assessments. With the U.S. example, with the War on Poverty, ultimately, the federal commitment to funding and coordination didn't last. And I think if you look at some of the more successful international examples, that's a key element, having more of this sustained government buy-in. So I think now we're seeing, there are groups in the U.S. that are doing really important work in elevating the voices of people in poverty to shape policy design. I mean, one that comes to mind is Witnesses to Hunger. They do really great work in connecting women around the country and so coordinating some advocacy efforts based on their experiences. But I think until there's more of government buy-in that really encourages decision makers to listen to these groups and these advocates, then they're not going to have as much of an impact as they could and as they should. I'll leave it there.
Great. Well, with that, I'm going to turn it over to you guys. There's a microphone, so please wait until it comes to you for the benefit of our online viewing audience. So feel free to jump in.
Hi there. I'm Ashmi Sheth. I'm from the Bipartisan Policy Center. And I have a question. You guys brought up Wells right from the start. And obviously, the government and the banking system is really intertwined. But in terms of just the OCC and the CFPB and this whole disconnect in regulatory architecture, I mean, how do you guys respond to the government's responsibility for Wells?
Your last word? Government's
For Wells.
For Wells.
Yeah.
Okay. I kind of joked on Twitter yesterday. I was like, you know, Elizabeth Warren's like her own fourth mini branch of government, right? When the other three like can't or won't bring democratic accountability, she will just like, you know, do some nut cutting in public, right? So I think she's like the public shamer in chief, but like the fact that it has to come down to that, like this committee meeting where she's shaming this, you know, individual who the other parties can't quite bring to justice, I think it's a nice YouTube clip, but it's an indictment a little bit of democracy, because I think, well, why wasn't this handled through the normal means of the way that things are done? When you do something bad, something happens. She did say, like, look, the DOJ should prosecute you, but they won't. And the problem is that technically, I mean, he did do some illegal things, but a lot of the bad action that happened during the financial crisis was not technically illegal. It was just, you had an incentive to make profit at the expense of your customers. And we allowed that incentive to happen. And so I think as far as the administrative response, I mean, I think the CFPB, I have been crazy impressed with what they're doing. I mean, they are the least captured at this point, either intellectually or actually captured of the institutions. The OCC has a pretty bad reputation. I mean, the OCC gets banks to sign up with them, and that's how they make their fees. And so their structure is, has a conflict, right? So a bank can choose either their state regulator or the OCC. And so you've got this race to the bottom with states saying, oh, we're more bank friendly, and the OCC saying, oh, we're more bank friendly. So what happens is, eventually there aren't any regulations, right? So for the OCC for years was preempting any state consumer protection law. The OCC would come in and say, we're preempting you. And what were we preempting you with? In other words, your laws don't count because there's a federal law on this, and it's our law, but their laws were nothing. Okay, so they were preempting them with no law. So we had these states trying to protect their consumers. Georgia was one, Michigan was another, Illinois was one, New York, and the OCC comes in and says, no, those are preempted. And so you have an agency that's actually working against the public interest. And so that's a problem of agency capture. Now the CFPB is not that agency. I think the FDIC does a good job because they have a fund to protect, right? And so they have skin in the game. So I think when we're talking about regulatory design, we really have to think, like, what is the incentive of these bureaucrats? I love bureaucrats. I mean, I'm proposing that the post office handle a bank, right? So I think bureaucrats can do things very, very well. They just have to have the right incentives. And the whole institution itself can't be incentivized to buy their constituents. There has to be some public accountability, and we haven't seen that with the financial crisis, and this is why Warren's tirades go viral, or you have a Bernie Sanders and Occupy Wall Street. And the Tea Party on the other side. There is this sense that the government's not doing the thing that we ask them to do, which is bringing accountability. So I think that mistrust has to be, and some of it is warranted, some of it is not. But I think that mistrust has to be dealt with before we can move on and create good public policy. I think a lot of people are just saying, start over. I mean, you see this in the current election, right? Like, let's just take everyone out and bring in crazy people. So, yeah.
So, I mean, part and parcel of accountability is also an enforcement mechanism, right? And a lot of that is validating, I think, alternate sources of information, right? I mean, this is essentially what Alita was talking about with bringing in, validated stakeholders representing people in poverty who are actually impacted by the policies that they're subjected to. But this happens in a very different way than public feedback is integrated into the policymaking process right now, which is done, via kind of town halls or submitting comments during the regulatory process, and it ultimately there is an arbiter, right? And that arbiter is not necessarily held to account to be responsive to that feedback. And I'm for all of you, I'm really curious when we're thinking about enforcement mechanisms, when we're thinking about metrics that should be used to evaluate the performance of financial systems, of policy that aren't currently considered now? I mean, what is on your short list? It's a thinker.
I mean, I can start. I mean, this idea. Jillian's talked so well in her work about the black banking sector and some of these inequalities, and I think we've got to. I think looking at these things historically, and Alita does this in her report as well, as what were these like. Divergences, and why did we choose one path as opposed to another? And a lot of it is there were politically interested parties and not a counter voice on the other side. And so we went this route, and I think black banking is an example of this. We've got this like minority deposit program that President Nixon created, right? So you've got this, we're at the crux of the civil rights movement. There are like riots around the country. We've got Vietnam, right? And so there are these options on the table, right? There are like black nationalists, right? So at that era, we can choose real fundamental reforms, right? That are gonna cost people, right? Or we can choose to keep our white middle class vote that is really opposed to integrating the suburbs, right? And that's what Nixon chose to do, and we're still facing that. And this is what he does with black banking. So Nixon starts black capitalism initiatives, right? So we're going to pump all these deposits into these black banks, and we're going to do that as opposed to the war on poverty that Johnson had started. And so why does he do that? It looks good, because why is Nixon supporting black capitalism? That seems, because he's anti-integration, right? Because he won't integrate the suburbs. So now that seems, 40 years ago, but arguably we're still making some of those choices, right? Why do we go this route? Well, what is the thing that we're trying to avoid that maybe costs more, but there isn't a public voice? And it's institutions, I think, like New America and others who are like, okay, well, we will articulate that public voice because some people are just too busy. They're holding down 3 jobs and trying to make it to get politically involved. So we have to have people speaking on behalf of those who can't, don't have the money, let's say, to speak for themselves.
It's a good place probably to, I was going to say kick it to Mark, who is the director of our political reform program.
It's a
fight over it.
It's a tug of war between the plants and the audience. I'm Justin King with New America, in the interest of full disclosure. This is fascinating. Mehrsa, I would love, we're coming to the close of the Obama administration. I would love a quick word on sort of perceptions on their track record on these issues. I think the public perception, at least the most vocal public perception, is big mistakes made early and anger over sort of a failure to prosecute and all that sort of stuff. But to me, the track record is more nuanced, and I want to raise sort of one specific example of that. There's a retirement coverage gap in America that's pretty well known. All the wonks know about it. I think people feel it and know about it. There's a gap in the marketplace. People are not covered by decent retirement products. And the government, under President Obama's leadership, decided to just create one, which they call MyRA, and is out there now. And literally anyone in America can sign up for a no-cost, low-risk retirement savings account. It has a lot of sort of limitations on it. But the idea now is out there more than ever that when there's a gap in the financial services product marketplace, the Treasury Department and the government can just create a product to try and fill it. That to me seems to harken back to a different era and also open doors to some really interesting possibilities going forward. So I know that's convoluted and long, but I think the 2 key things there are, I'd love to hear perceptions on the Obama administration's track record, and also what does this MyRA development tell us about what's possible for the future?
Yeah. I think when the history is told on the Obama administration, it's going to be very generous. I think it did the best with, I mean, there has been virtually no corruption, virtually, right? A real public serving institutions. The problem here was, I mean, if you look at the timeline, they entered into the financial abyss, right? So they turn over, and we've got a lame duck rolling out TARP, and they entered January, right, of 2008, mid-collapse, right? Some dominoes had fallen, many were yet to fall. And what happens during that time, what any good leader would do is not completely reroute the ship. And what they did was bring on a lot of the same people who were in charge of guiding that, who had been guiding that ship for the last 20 years, right? These are the same ideologies, literally the same people who had been in this, right? And so I have read every memoir of the financial crisis, written by every single actor, and all of them, right? We're talking about Bernanke, Geithner, Paulson, Sheila Bair, exactly. I mean, name it down, except for Brooks Lee Bourne, who was already out by then, but she was a good counterexample, and so was Bair. But it was the same administration. I don't think you can accurately, I don't think you can say this was this huge shift, but what I will say is it did shift later. After we got out of the financial crisis, which I think could have been, I think there was a window of opportunity. And had he had been a more seasoned president, had this been Obama's second term this time, had it been, different Congresses, I think we could have had some foundational reforms, which is what we needed. We really needed more, but I think they did the most with what they could. And I tend to be generous to them because I think the alternative was not as good. And I think when they kind of got their feet under them, Dodd-Frank is fine. And the CFPB is great. And these, ideas that the government is going to create, like you said, fill these gaps. Yes, we do have that ideology. And I think the country is divided, but I think less divided than the press would make it out to be. I think we're on the same page, essentially, about the financial, that it's all screwed up. And that, for better or for worse, I think we're a little bit all cynical at this point.
Mark?
I had a little bit of a bad flashback yesterday. I worked on Capitol Hill during the welfare reform fights of 1996, and I saw the lineup for the panel to discuss that topic at another think tank, the Brookings Institution, this morning, which consists of basically 75% white men. And it reminded me that episode was really one in which people were making decisions entirely for other people with very little, either input or protest. There's a line where Senator Moynihan, as the bill's passing, says, I can look out the doors of the Senate here and, see all the way down to the Washington Monument. That space should be full of people protesting what's happening here today. And so I'm interested in your thoughts. I do think that, despite that flashback, we're in a very different place right now in terms of political activation around issues. And I just wonder what your thoughts are about how to create more of a real movement that engages people, not about welfare, because I think that's a very hard, in a way bridges some of the topics here so that you're actually talking about how you can create inclusion and how you can, make that bridge to the point where people are able to save and build some of their own financial security, and how best to do that. And I am, it's nice and generous to say New America can kind of be that voice. I mean, I think it will be very frustrating that can't be resting in institutions like this. I mean, we can certainly help facilitate some things, but it really needs to be kind of a part of the agenda of really what people who supported Bernie Sanders were into, and an extension of the BLM agenda and a bunch of other things to really matter, and has to be a positive, not just a negative agenda. And I'll let you turn that into a question.
Oh, I had a practical note on that. So I think one of the things I hear a lot and I see a lot when I'm reporting is that when people are talking about and trying to figure out how to solve problems for people who are low income, who have all varieties of disadvantage, forums will be hosted. People will say, come to the Capitol and protest. People will say, come to this meeting. And it's always, come to us where we are and tell us of all your woes and how this does not work. And that is just not a practical thing. That is not a practical thing to expect of people who we've already said are trying to take care of their kids with no childcare, who are trying to get to jobs so they don't lose them that are minimum wage, who are counting their gas mileage so they don't go over, so they can get their kids to school and then get to work. I'm sure it exists, but I don't see a ton of people kind of branching out and going to where people already are, where it's already easy. And one of the best examples I can think of this is in New York. They were redistricting some of the school zones, and it was going to involve a bunch of low-income black kids being moved into this very affluent school. They had a big meeting about it at 6 p.m. on Upper West, Upper East Side, and the thing that I heard from a lot of parents and school administrators afterwards was that they were so bummed that none of the parents from this low-income black school had come. And one, they don't feel comfortable going there. They feel like they are not wanted there. They feel like their voices are not going to be heard there. They feel like they're going to be shouted down there. They feel like they cannot compete with the voices of these educated white liberal folks who are going to make these intellectual arguments about essentially why their kids are lesser than, whether or not that's what happened. That was the feeling that I heard from a lot of these other parents. What would have made more sense, in my opinion, and I'm not sure if that's true or not, but it didn't happen, was all of these people going to school pickup or being around when these parents are required to be around and just saying, hey, how are you feeling about this? Be there at like 2:30 when they're getting their kids and saying, yeah, do you have some thoughts about this? Like, put the onus on yourself to go reach out to these folks. But that's just, again, that's practical. That is not like a higher level.
It's not a higher level, but I think it really creates some insights about what would be necessary,
Yeah.
right? And it shouldn't be incumbent upon either like institutions like schools to like in a one-off way figure this stuff out, right? I think a lot of it goes back to what Mehrsa was saying about incentives, right? I mean, how do we build in incentives? How do we make these institutions accountable for integrating those voices, right? And one version of this would be like CRA, right? I mean, CRA evaluates banks on how they're serving their communities in some way and uses that rating to some effect in some decision making. So it's not a completely perfect example, but I mean, it shows that there are precedents, right, about making sure that institutions are serving not just a narrow set of constituents. And I think it's going to be figuring out how to get the incentives right, how to really build in those hooks and build out community capacity to engage in that process too.
I mean, I am like hugely optimistic when it comes to all of this. I really think we are seeing with the Donald Trump campaign, I hope I'm not wrong, but I think we're seeing sort of the last gasp of this, backwards looking, xenophobic, racism, sort of like this power grab of this dying. I really think that this is, I am very hopeful. And the reason I'm hopeful is because we're just smarter. We talk to each other more. I mean, Twitter is like a cesspool of awfulness. I'm sure you know this because you're a public figure. I've seen a little bit of it as an observer. But it's also a place where this stuff gets aired out. I mean, I think the fact that you can point out that they've got this all-male panel over there, and we have like an accidental all-female one here, but like this wouldn't have happened during the first welfare fight. And I think you are seeing progress, and so I think we're keen to pointing out the places that we've not progressed, but I think sometimes we're just we aren't noticing in the ways that we have made leaps and bounds, especially in just talking about racism, right? The fact that, Jillian is writing about black banks in a critical way, right? To say, like, can this do the thing that, as opposed to, and that the black banks are saying, well, what is the role of black banks, right? In the society that is, are we pushing for integration? These conversations weren't happening in this way. I've read the historical documents in the 60s. It was a very, very different conversation, and it's striking how differently we talk about this stuff and how many more people care. And so I do have a lot of optimism about this. My part is I'm a historian, so I like to tell the stories of why we got here, and these two I think do as well. I mean, I've read their work, and they like to grapple with this history and create these new narratives. And then you all, New America, does their thing, and then what I think the missing thing is, how do we get voters? And I don't know, but I think it's got to be through these new methods of communication. I mean, Facebook and all of this stuff. I mean, you all know more than I do about how to mobilize, but I like have a lot of faith in this new generation. I teach them, right? I see. I've been doing this now for 10 years, and my students have gotten more and more, and I teach in Georgia, right? And this is an institution that has an ugly history. And I see my students every year have better words and better ways of conceptualizing where we're at. And I don't know, I mean, I could be just crazy naive here, but it seems to me like it's changing for the better.
As a native Georgian, I would like to affirm that there are positive things that have emerged out of our state. So I think we have time for about 2 more questions.
Hi, Dan Schwartz with the Conference of State Bank Supervisors. First of all, I want to say thank you for holding the panel discussion today. It's a really important topic. So back in June, the CFPB released their proposed rule on small dollar lending. Without the ability to set a federal usury limit that was not given to them by Congress through Dodd-Frank, it resulted in a rule that's really complicated. It's very long. It has a lot of loopholes. And specifically, there's concern that it still allows for very expensive, longer-term installment lending, and concerns that the Bureau may have kind of missed a large shift in the payday industry from storefront short-term lending to longer-term installment lending, which can carry equally high interest rates that are potentially harmful to consumers. So my question would be, first, what are your thoughts on the rule? Did they achieve the right balance of regulating the market and also ensuring access to credit? And second, banks are also covered lenders under the rule. So what do you think the Bureau can do to ensure that community banks or minority banks or community development financial institutions can provide a source of credit within their communities under the rule?
Yeah, that's a really good question. So I'm actually going to the CFPB right after this to speak with President Cordray and his group on this. We were on a panel 2 weeks ago, and I wanted to continue this conversation because what I said to him at the panel was, this is great, this is a great start, but if you're going to diminish this market, you've got to create an alternative. Otherwise, the workaround is already starting. I mean, there was this Bahamas conference meeting where the payday lenders came right as the rule was being announced, and they were already talking about how to get around it. And as you've said, one is online, Native American reservations, offshore, right? The other is, one of the ideas literally at this event was, because you can't do loans, but you can offer credit at high interest. So why don't we sell a thing to you at the store? And the thing we're selling is a debit card. So you're going to get credit at 300% interest, and you're going to walk over to a machine that dispenses debit cards. So essentially, we're lending you $500, but we're going to work around this regulation, right? So this is an industry that is innovative and very creative. So I think the rules are a great start, but as you said, they don't have the power to impose usury. And it's been this, and the states, there's this race to the bottom on the state level, as you know, because you do these state bank supervision. So I think it's a great start. They did, the Ability to Pay Act or standard, and installment is better than payday. This idea that you can't double charge on their accounts, right, to withdraw. There's a couple of really, really good things in there, right? But it still needs that other portion. So if we're going to diminish their lending capacity, we've got to create an alternative. Your question about the community banks, from my experience, black-owned banks and community banks have not historically been interested in these small credit loans. There are a few the community development credit unions that are still doing this, but there's about 100 or so in the country. There's a few nonprofits that are doing this. Again, I want to say a dozen that I know of in the country, so not that many, but yes, this does affect them, and there needs to be an understanding that there are these nonprofits. Although I will say that the nonprofits that I know of are doing already what the rules require, which is much lower interest, more disclosure. So I think it's a great start, but will it, eliminate the market? I don't think so. I mean, the payday lenders are going to fight this and say you're going to put us out of business, but I don't know. I don't think so.
Yeah. I was just going to add to that. If, anyone who listened to the comments after that rule, I listened to it for 4 or so hours, which was a mistake. But yeah, I mean, they had workers from these various payday outfits come in and say, you are taking away our jobs, you're taking away our kids' abilities to eat, et cetera, et cetera. This, it was a good start. It was like step 1 of 15. And it is whack-a-mole. And I think I totally agree with what Mehrsa said earlier. We cannot regulate our way out of a problem this big. You can keep putting stricter limits on these small, different facets of this lending. The problem is that the demand exists. The problem is that people who do not have credit and who have low incomes and need these bridge loans need money. So they are going to find somewhere to get it, and people who want to make money off of it will find some way to provide it at as much of a profit as humanly possible, unless and until states are able to say, actually, no, we're not going to do that, or the CFPB can say, no, actually, you can't do that, or there's some very clear and distinct language coming from regulators to banking outfits that says, hey, actually, this is a thing that you guys should be doing in the private sector, and let's just super clearly outline for you guys what that would look like, how it would work, what the regulation and the framework is around it, and get going. So, I mean, I think we are still several steps away from that. I think, we can't discount what was done and just the sheer attention that the CFPB in the few years they've been around brought to the issue, right? This was not something that we were talking about as a mainstream audience as much before they start saying, hey, this is a really big problem, but I think we have a real long way to go.
It's like what Alita points out in her work is instead of providing real welfare reform to get people out of poverty, we've left them to credit. And credit doesn't fix poverty, and it can help. Cheap credit can help. Credit is the reason why we have a middle class here, right, through these mortgage loans and student loans, but these short-term loans are no replacement for real, poverty reform, which we have always managed to divert away from.
All right, one more right up front.
Thank you. Reed Kramer at New America, and really so happy to have all 4 of you up there today. People need a place to manage their money. Everybody does. And we've identified for years now, almost decades, that low-income people often are unbanked or underbanked. They don't have these relationships. And we've identified now 2 mechanisms or possible solutions through the public assistance system or postal banks. And I guess I want to hear a little bit more about that from each of you, I guess. So with the public assistance system, a lot of now benefits are coming on cards. And a lot of people access accounts kind of via cards, but some of them have better terms, insurance, FDIC insurance. Where, Alita, can you describe those shortcomings with TANF? What are the fee structures? Could we just expand it to allow some more financial services to kind of come through that system, and what are the gaps now? And then a little more on postal banking, like, what are the current dynamics? This is a system, it's an infrastructure, they move money around, they have some real skills. Yeah, tell me a little bit more about the unions, tell me a little bit more about the regulators, what is the pushback from the banks? a lot of these large financial institutions haven't gone after this market. It's just sat there forever, and we allowed the predatory lenders to come in and obviously show the size of it. So, you know, what would be some of the dynamics and the political debates and hurdles that we need to get over here? So those are my two questions that I just kind of squeezed into one.
Okay, so in terms of TANF, as you mentioned, you know, most states do deliver their benefits through electronic cards, and I think the shift from paper checks to, you know, electronic delivery was a real step in the right direction. But I think it hasn't gone far enough, and the way it operates now is really sort of just relegating people to a system that is kind of subpar. You know, and the rules vary a lot by states in terms of what the fee structures are. You know, some states don't allow any free withdrawals with an EBT card. Some states only allow you to get cash back through a point of sale transaction. And you know, the implications can be pretty huge. There was a report that came out a couple years ago, a great report from the California Reinvestment Coalition, that described how there have been $19 million in fees paid from EBT cards in 1 year. So this is money that's supposed to be going directly to low-income people to meet their basic needs, and instead it's being, you know, siphoned off one ATM fee or surcharge fee at a time. And you know, there's also limits on functionality. You can't use EBT cards for online purchases. You can only use them at certain retailers, and like I said, there's this limited ATM network now. No deposits, no opportunity to save, none of that. And then obviously asset limits are another barrier to saving within the same system. You know, a lot of states do offer direct deposit to the recipient's bank account, but it's not the default option in any of the states that I've spoken to people in. The EBT card is generally presented as this is how it happens, and there's not an easy way to select direct deposit to your own account, even if you happen to have one. And with some of these new rules, some states have even eliminated that option as a result of these restrictions on where and how you can access your assistance. Arizona eliminated the direct deposit option, which is under a misguided assumption that that's what they were required to do, and that ultimately moved, you know, thousands of people from getting their benefits directly deposited to their bank account, which very well might let them avoid more fees, to getting it on the state-issued EBT card. And I think sort of a bigger issue is sort of more the symbolic piece of it. You know, there are other programs where we say, you know, yes, make sure direct deposit is the first option and a default option. Unemployment insurance is one of those. But for these means-tested programs, you know, we're saying this system isn't for you. It's just sort of this implicit message of saying this, of exclusion. And I think that is one of the really troubling aspects of it, aside from the practical implications.
Alita, so it sounds like the upshot of what you're saying is the major barrier to leveraging TANF as a platform for building financial inclusion is federalism.
There's a lot of issues with federalism, I'd say.
That can be your next paper.
Yeah, so the postal banking idea, it's still early. Unions are heavily on board, very, very on board. Both huge, the post office has two big unions, the letter carriers and the APW, which is the tellers, and they have both asked for this. So you know, we're still in the early stages. You know, I have no political position, but I've been sort of coordinating some of the efforts here, and so far positive responses from across the board, but also so far nothing specific. That may change later this afternoon. I don't know. It's possible that there could be talk of maybe a pilot or something like that. Nothing yet, but that's how it would start. Is we would try to demonstrate some of the ways to do this. This won't go from zero to full postal banking within the next year or so, but we are hoping to start incrementally just to show how it might work. Now, I should say that the Postmaster General is not on board yet. And so that is a politics that this is not my world, but I think that could change depending on what forces are brought to bear, et cetera. And the new administration, of course, but it's in the we got it in the Democratic National Platform, postal banking. So, you know, at least a big chunk of the new administration is at least interested. Yeah, did you write it? Yeah, it's in there. Yeah, and that was a huge win, and I think that was, you know, fought for by Senator Warren and Senator Sanders, you know, and of course the unions who endorsed the candidate.
Great. Thank you. Please join me in thanking our panelists for a really terrific conversation.
Thank you.